This is special coverage of the Fed decision. Let's get into today's video. Well, welcome, folks. It's been a little while since I've been on. I'm actually out of town right now, but I wanted to come up and cover the Fed today, talk about a couple of things that I think is going on. So just waiting for the room to fill up. So I'll go ahead and get into a bit of the discussion of what I think is going to happen. Yeah, it's been a month since I've been live, so I apologize. Those of you that are aware, my wife is fighting cancer and we're trying to save her. So that's what we're doing down here in Phoenix, Arizona. So anyway, hope wish us well. And let's get into talking a little bit about a couple of things. And I've been, those of you that get my Substack know that what I've been talking about is, for a while, actually, just following me here on YouTube over the last 2 years, is one of the things that I've been talking about is that the Fed is continuing their process they started 2 years ago. And I think those of us that have listened and paid attention to the Fed and not tried to tell them what they should be doing and those type of things, we're seeing a lot of that. It's interesting from my viewpoint, from the standpoint of what we see the talking heads out there. I'll get into some of the details here in a minute. So we'll just kind of fill the space until we get some more viewers in here. But the bottom line is that the Fed has been working a process for the past 2 years. The very first part of this was fight inflation, right? Let's beat the inflation. Let's get that out of the way. And so did they beat it? Not necessarily. Did they actually do anything? I'm not sure. Okay. I would argue that the supply chains came back in the line. A lot of things happened after the pandemic and everything just kind of normalized on its own. I'm not sure the Fed strategy's done much. The only thing that they did do, which they wanted to basically, to get rid of inflation, they jacked rates to over 5%. And that really set the tone for this normalization. Let me just see how many, I don't want to get too deep in this conversation. We'll listen just because there's a lot of things I want to talk about. So we'll let the decision come out here in a few minutes, and then what we'll do after that, I'll go through this scenario of what I believe the Fed is doing. So it's kind of interesting. I don't have a green screen here, so I've got there's a map. I'm actually at an Airbnb in Phoenix right now. So anyway, we'll just kind of chat up. If you have any quick questions, I see some folks coming over from our Discord. A couple of things I will mention this, and I'm excited to tell you that on January 23rd and 24th, I'm going to be doing a symposium, and it's going to be a 2-day event. It will be a live event. Let me just put something up here, and we can fill the space with that while people are coming on board here. And let me just see if we can get over there. Yeah, so we've got the markets up there trading. But this strategic trader, I'm doing something very interesting. And I think if I'll put the link, once I finish this video, I'll put the link, but you can go to kindlereport.com/event. You can sign up there. The first 30 people that sign up are going to get a 1-hour consultation with me. And so that's going to take me a number of weeks, but I'm going to put up a calendar, and you'll be able to come on board and see and set up a meeting that will work for both of us. I'll have times and schedules and all that stuff. So I'm excited about that because through Discord, our private Discord. When you buy the indicators, you get the Discord, all that stuff. It's primarily what I'm going to be doing on the symposium is I'm doing two things. I'm going to show you exactly how to set up trades, entry points, exits, but I'm doing something really unique. I'm giving you 3 months of my portfolio management software included in this, because I'm going to show you how to use the WaveTech software to actually confirm the trades so you can learn how to use the indicators at the next level, because all the indicators are part of the code that's inside the software. And it's not all of it, but there's a main portion. I'm going to be able to really show you how to get things set up. So I'm excited about that. And so anyway, just putting that out there. So it used to be, and I couldn't find, let me just see if I can get one more thing up. I've tried this before when I tried to rebroadcast YouTube or anything like that. They haven't let me, believe it or not. I don't know why, but YouTube doesn't let YouTube TV be broadcast. So I'll put the sound on when they talk, do this. We'll listen to Paul's comments, those type of things, and all that. I'm excited about the symposium. There'll be more to come up. I've got a whole bunch of stuff here. So if you go to this link, it's going to go through and get you all signed up and all that. So let's put this back up here just for this screen here. I've got a 5-minute graph here. Let's talk for a couple of minutes here while we're getting going. Is one of the things that I think is it really doesn't matter whether the Fed lowers rates right now or not. When we get done, once I get the decision out, I'll go through this scenario and kind of go in between the lines of what I was talking about in last night's Substack and talk about the yield curve and the other things that I think was going on. And we'll go through oil. I'm going to spend a couple hours here with you folks. I appreciate it. Just looking at some comments here. See a lot of familiar names. It's good to see everybody. It really is. I do have some intentions. There's one other thing I'm going to tell you folks. I'm just going to drop. This is going to be something else. Not only is the symposium coming, but I'm going to start an inside, what I call inside circle. And there's going to be, I haven't figured out the schedule yet, but it's probably looking into early February. It's going to mimic a little bit of the old live trading room that I had a couple years ago. So we're trying to get re-engaged in a different way, and this will be private channels and that type of stuff. And hopefully I'll be able to get on YouTube more often as we go forward here. So let's see here. We've got the typical. They always bring this guy in, this Kelly guy. He's fairly smart, but he can't say R's. It's kind of funny. Everything's like the wabbit. Let me just look here. I'm just looking at a couple of things. Yeah, so I'll put the sound up on this when we get going. You just go to kendallreport.com/event. No, not events, but event. And that should bring you to that. You should be able to sign up there. No name. Do me a favor. I'll have to send me a copy of your receipt and your TradingView username to info@kendallreport.com, and I'll see if I can get that handled for you. I've been out of town a lot. I actually had someone that worked for me for a long time is no longer with me, so I've been kind of scrambling with other events going on in life to get some things shored up, so we'll do that. Yeah, there's a good question here. Where are we at on time? You know what? Let's go over to the sound, because I think excuse me, they're getting ready to announce this. So let's just put some sound on. Then we'll get into chatting.
2026 looking for 2. That's where we are right now.
You should be hearing this fine. Just give me a...
Rate cuts at this stage. They might take half those rate cuts off the board. So that is a significant change. And I think they want to indicate, look, we're not going to have that many rate cuts going forward.
That is a significant change, and I remember thinking back a year ago to where many people were saying we're going to get 6 rate cuts in 2024. Well, we're going to get half that many. Maybe if you take that and say,
well, it's out. You can see the screen. We just got a dip here.
Where you are with a couple next year and maybe a couple in 2026. It is almost that time.
There's no liquidity in the order book right now if you look on the far right. It's already out. There's a delay in this TV. Here we go.
The Federal Reserve cutting interest rates by 1/4 point to a new level of 4.25% to 4.5%. The committee says in a statement it is still, quote, considering the extent and timing of additional adjustments. Now, the Summary of Economic Projections says it raises the average expected rate to 3.9%. That's an additional 0.5 point than what had previously been forecast, or just 2 cuts now projected by the committee, by the average committee forecast, down from 4 1/4 point cuts that have been projected. Same for 2026, which now goes to 3.4% expected from 2.9. So that discussion you're just having, yes, the Federal Reserve did indeed reduce the number of rate cuts it projects for the average committee member next year. The neutral rate is now 3.1, up from 2.9%. One dissent, New Cleveland Fed President Beth Hammack, who took office just a few months ago, she preferred to hold rates. Bottom line, the committee's still heading down, but at a slower, perhaps shallower slope. Economic activity is said to be expanding at a solid pace, and if you've heard this before, it was really a carbon copy of the prior statement when it came to the economy. Labor market has generally eased. Unemployment rate is up. There's been progress on inflation, but it remains elevated. The outlook is uncertain, the committee says, looking at risks on both sides of the mandate. More on the projections here. Growth was raised by 0.5 point for this year to 2.5%, back to 2.1 and then 2% in the next several years. Unemployment now seen down 0.2 from the prior forecast, that is, to 4.2 from 4.3 over the next 3 years. And one more thing, the more important issue of inflation, where the core PCE is seen up 0.2 to 2.8%, 2.5% the next year, and then it gets down to trend in 2027. That's the 2% number. So 1/4 point cut, still considering additional cuts, but considering fewer, or forecasting fewer cuts than it had been in the past. Tyler?
All right, thank you very much, Steve. Back to you.
All right, so markets got exactly what they were expecting, and you can see how react. I actually got an error in TradeStation. I was actually going to buy that dip, and I may have to take a. I'm running that on a remote computer. It's running at my office up in the mountains. So fortunately, I got an error. I was going to go in there and grab that dip there. This is one of those contra trend trades I talk about. So let's just talk. Okay, they did another 1/4 point. So if you go, they've got it down to from 5 1/4 now until all the way down to 4 1/4. And if you recall, those of you who've been around for a while, I've been talking about the yield curve actually going flat. I'm going to bring something up here, see if I can bring this up full screen for you. But this is this I had in last night's Substack. The red line was where we were at the beginning of this year. So this was the big inverted curve, the red line. The black line, let's see, let me make sure, it's sort of a dark green. That was going back to 2022. That's what we looked like. And then the blue line is where we are right now. And one of my arguments is that we'd get down around 4% and you just draw a flat line across the screen. And that's pretty much what we've got, with a little bit of a hump on the back end here. But my goal is, let me just go to a different chart because I can actually bring up something here that will look a little different. Let's do a couple things here. If I can find that graph. Here we go. So this was from last night's Substack. And one of the things that the green lines that are an angle, this is where I think it's going. So from my viewpoint, I think there's another full percentage point on the downside to be, and that could happen by the third quarter. If you were allowing the markets to trade in a free market trade rather than being a manipulated trade, and right now you would probably be about 3.5, maybe 3.25. That's where the markets would be. One of the things that I talk about all the time is to get a healthy banking system going again. These green lines, these straight lines that are the forecast, my forecast, are really what they're telling you is that that's a normal line. So what do banks want to do? They want to borrow short and lend long. So they need to be a premium there. And typically it's about $1.50. So if you're at 3.25, it'd be 4.75 on the back end. And that's pretty much where we're printing around. We've been hanging around this 4.25, 4.5 range on the 10-year, and that's pretty much what I'm expecting that's going to stay. And the front end's the only reason I'm going to show you another chart here. See if I can find the right chart. And I think this chart, I believe it's this one. Yeah. So this is the Fed funds rate. And this is where we were back in 21. This was the launch, the liftoff. Then we got the flat. They held them flat. And I might bring this chart up on TradingView because I want to show you some other things here. But the forecast right now is coming down towards this line here, which is we're getting pretty close to this right now. That's 4%. I think we probably end up a bit lower. I still think we get 3.5, 3.25 out of this segment before it's over. And it going back to this other chart here that I was just showing you. This is like the perfect world. This is the Goldilocks, not too hot, not too, it's just right. So you have around 4.5. You add another buck, depending on the spreads, another $1.50 on the mortgages. So you're looking at, 6% mortgages. I started in the real estate business in 1975. You have to remember I'm an old dude. So I started in real estate business and interest rates were 6% roughly. And if you look at the normalized rate across over time, 6% is about where rates tend to hang out. And we've a little bit below, and we've seen something when it came through the GFC back in 2008. We saw this big disruption of how things normally were because they liquefied the banking system, and they dropped rates to zero to offset all of the craziness that was going on in that moment in time. So, and then of course the next time they did that, we know, was during the pandemic when they turned the economy off, right? So that was the next reason. So what we've seen is these shock waves coming in. But normally, this is what you want to see. Whatever the front end is about $1.50. And 2.25 is a little too steep, but 1.5 is the perfect number. Powell said something going back some time ago. I want to say it was over a year ago. And I've talked about this before, but one of the things that I thought that I heard anyway, as Powell said, they were about to embrace on a different strategy that they felt long-term was going to be very positive. And I have mentioned this, William McChesney Martin, quite a bit. He was Fed chairman from 1951 to 1970. And if you look at all the charts on interest rates, inflation, everything, once Bill Martin got out of office in 1970 and Arthur Burns came in, everything got all jacked up. And we've just seen inflation and all these surges, and all of the Fed chairs that have existed since then have had their own little, during their tenure, have had different things that were going on. And the event of, from my viewpoint, is I think they want to get back to a market-driven rate. When I grew up in 1979, we came in to a world of massive inflation. Paul Volcker had started this crazy, raising rates to kill inflation, and it worked then. If you were watching when I first came live today, you'll know that what I was saying is I'm not sure that what the Fed did with raising rates to 5% actually did anything with inflation. I think most of it was coming out of the pandemic and normalization of supply chains, and everything kind of got back to where it was. Maybe it did something. I'm not sure. Looking in the rearview mirror, I'm not so sure that they were that effective on as far as that the strategy has been all that effective. But what it has done is it's caused that back into the yield curve and this process coming here. Like you can see, like I said, the red line was the big inversion. Remember everybody, there's a recession coming, all that stuff. No recession. Bob told you no recession's coming. And the reason for it is this chart over here that I'll show you. I'll bring this back up. Is this chart here is what the Fed's been doing is artificially moving this front end of this curve around. So that's why we had the inversion based on where we were as far as rates go on the back end. That was demand driven. That was a market driven rate. Where the front end is where they've been moving this around, changing these spreads and changing how the system is going to advance from. I would have been in and out. Somebody says it's still falling. Let me just see if I can. Let's see if we can get back over there. Yeah, 21. Yeah. Anyway, so I would have been scalped in and out in 30 seconds. So I wouldn't be buying for, yeah. Anyway, but the point of discussing this is really is what to expect in going forward. I'm hoping that I will have. I don't know if I'll get it done this weekend. Possibly by the following weekend, I'll have my 2025 outlook done. And one of the scenarios that's building is that we're going to walk into a little bumpy kind of scenario as we come into 2025. And a lot of it has to do with we're still trying to normalize these rates. So, yeah, and I see Robert's saying that the Fed funds rate is the same as the 10-year yield. That's the flat. I've been talking about that for a year. This is where we were heading. Now the next steps, there will be further drops because they want for the banking system to work right. I was hoping that Dr. Baker would show up. He could comment on. But the bottom line is, what you want is that front end a bit lower, and then you want that stable back end. If we can get that level going, and we should be able to see some really decent economic activity. We got a new. No, I am not long right now. No. So one of the things that, like I said, that I think the Fed's trying to do is to get back to the market-driven rate. So if we go back into the 70s, and I know that's a long time ago, and I always criticize those who look in the rearview mirror, but this is about banking structure. This is about financial structure and how the system, like I said, banks want to, borrow short and lend long. They want that spread. That's how everything works. That's what makes the world go around. And we've been so out of whack by watching this manipulation that's been going on by the Fed. It's been it's been extreme, right? So just going back and forth between the charts. I mean, look how they artificially swung this thing down. Let me just see if I can pull up something here. I don't know if I can get this to work or not. But let's just see here. Yeah, let's just see if I can. It's on a bad scale. Let me just see if I can get this to work here. I'm just trying to get something to pull up, and it's not being friendly with me right now. Bear with me 1 second. Not sure why it's not showing up. There we go. All right. So this is one of the things I wanted to show you, which is kind of interesting. We can go into this before Powell comes up. It's about quarter after. What I want to show you is something that's been going on for a while with the Fed. This is going all the way back. This is where my cursor is right now in 1992. But this long period here, this was the GFC. I ran the algos going in the past. If I run this out, you can see that the let me see if I can get this scaled so you folks can see it. It's more dramatic and you can see it a little better. So one of the things that what we see is because of the way that the configuration is, you see these massive swings. And if we go back to, excuse me, 08, we're looking at 07. We're looking at yields around 5 1/4. We went just a touch above that, and now they're swinging. So this big, giant swing range. And anytime you see these flats, this is where the Fed is fixing rates artificially, and they pushed them up. If we go over here, you can see this goes back to 2003. This was Greenspan days, right? No, yeah. So they did this quarter point deal all the way from 2004 all the way to 2007. Like every meeting, they raised rates. It was just incrementally. And Powell right now, if you recall, he claims that if we come over here to where we are right now, that we are not on some scheduled drop in quarter point. I think we are, whether they skip a January or not. I think they will continue to drop rates on this thing. So let's okay, well I'm talking theory here. Let's go over and take a look at the markets, but you folks get where I'm coming from here. Let's just come back over here. Yeah, this thing just keeps going down 40 handles here. Like right here is where I was going to buy this. I was just going to scalp out of this thing, and then it just turned south again. So I'm glad I got an error. At least the platform didn't fail. Let me just look and see. Yeah, so let's go over to ES. It's making me crazy with this rollover we have right now, but let's go over to the 5 minute. Let's see what the algos are telling us. Let's take a look here. That's good. Yeah, so we're getting a potential bottoming formation coming in here. We got a little work to do. It looks like into about 45. So we got another 25, 30 minutes of work to do here. To get this scaled out so you can see it. But yeah, we got this crazy drop. So this is one of the things that folks have been talking about, right? Is that this was a was a hawkish drop. So it's interesting, folks. I've been around a long time, and one of the things that I see happening is that the tail is wagging the dog. So the rhetoric and the algorithms, we live in a different world now, and this is part of what we're seeing here. Should this be this drastic of a reaction? Probably not. Although if you look at our database, things I've been telling you about in the Substack every night, is our database is, on a short-term basis, has collapsed. Last week's intermediate run has actually changed substantially, and it's starting to show declines. We have a long-term, kind of a long-term signal that came out last week on Monday, and we got liquidation on a particular strategy that doesn't trade very often, but we got a liquidation signal on that for Monday. So we're starting to see a lot of shifts here. And like I said, I think we come into 2025, and I think we got a bumpy road. Now, if you notice the algos, there's something here. If those of you have the indicators, let me just see if I can bring up something here, and we'll watch this chart for a minute. But this is an interesting pattern that's coming out right now. And I'm just going to draw in some things here. You can see these orange lines are the extremes. They're right here. So typically what's going to happen is, this is a 5-minute graph. We're going to start to see the market grid come in and set up some kind of pattern here. The market is likely to trade within, let me change colors. The market's going to trade in this range, and that's what the algos are saying, is that there's going to be a consolidation. Is it going to rebound here? I don't know. It's way too early to make any kind of predictions like that. But we should see the blue line should be a contraction that's going to happen here, and we'll see this market kind of come in. We'll go back into theory here in a minute, but I kind of want to make sure that you understand that what the Fed's doing is actually, I was really impressed with Jerome Powell. I thought he was going to be maybe the potential, maybe he still is, but potential Bill Martin of the next of this generation. He's a little old because Martin came in pretty young from that standpoint. So as far as Powell goes, we're likely to see him attempt to be Bill Martin, meaning that he wants to stabilize and get back to market-driven Fed versus the manipulation that I was showing you a few minutes ago. Yeah, I think this is what I'm saying here, Bob Mango. I'm telling you that we've got some challenges as we come into the first of the year for sure, and probably into mid-year or beyond. I know everybody's excited, or a lot of folks are anyway, about the new administration and being business friendly. But there's a lot of challenges. This thing has been turned upside down. It's not going to just turn back and everything's going to be wonderful. I know it's good to talk about, but it's not likely what's going to happen. But you can see if you can go through my let me just clear out these bars here. You can see the algos are starting to forecast that we're going to start to stabilize here. So these dotted lines here are actually the forecast of what the moving averages are going to look like. So we can kind of get a feel for this. Folks, I need to just break for 1 second. Just give me 1 second. Okay, thanks for that. Yeah, we're just looking. You can see it's starting to come back in. Like I said, these orange lines. Let me blow this up so we can see this just a little bit better. Yeah, I'm just going to stick with this. I'm not going to bring the PPMs up for a moment. But you can see the red dot is forecasting where the bars are going to come in, and you can see that these orange lines, which are extremes, are already starting to collapse in, and you get what I call a volatility spike. If you've used Bollinger Bands, you know they get that bubble when the volatility gets real high. Well, those are based on standard deviations. This is actually a market-driven range prediction, and then there's levels. If you look over on the far right-hand side, it tells us where the market's likely to go. Like right now, resistance for this 5-minute bar is at 60.27, 60.30, 55, and so far we've been 27 even. So it's coming right into R1 on the resistance at the moment. But the patterns that we should see this thing come in, and it's a 5-minute chart. So where are we at here? We've got 3 minutes to go in this bar, but we'll see this thing probably turn down and start to collapse around here, and then maybe we can determine whether we're going to get some kind of recovery. That was pretty steep move from that standpoint. Let's take a look at. I just want to see if I can get the order book back up here. Yeah, this is the order book is pretty washed out right now, and what you're looking at is the bid ask. There's only 10, 20 on each side of the trade, and typically these are where we're looking at is probably 100, 150, 200 aside. So you can see that there's no liquidity out there, and this is pretty typical right now. So the markets are pretty washed out from that standpoint at the moment. So let's go ahead and put this chart back up. But you can see we're coming in. We're really just starting to get into that range. So the forecast is starting to normalize. Everything's starting to normalize here. So when you get a big break like this, it will take somewhere between 4 and 8 bars to normalize in this kind of range. And we look at the PPMs. This is what I was talking about. In about another 15 minutes or so, we're actually seeing a forecast for that each one of these indicators are mapping out to these moving averages. So it tells us what the probabilities are for the market to get above that. And once we get across over this first derivative here, then we'll probably have a shot at least testing this 10-period moving average. And it's declining pretty sharply right now. So when you get a break like this, it takes multiple bars. So if it was a daily bar, it would take, might take 5, 6, 8 bars to normalize and start to get into the point of what we're expecting here. Just looking at Yeah, so let's take a look at the Dow. Let's bounce around a little bit here. It's interesting. The Dow has some Fib projections right now: 109, 109.81, 111.60, and 112.78. So this is these dots up here are the Fibonacci projection. So yeah, we're just kind of. Yeah, so there's the new lows off of this pattern. So heavy selling. So listen, I was talking on Substack, 59.15 is a target for this thing on the downside. So they're still punching out the lows here. We're looking at like I said, the order book, there's nothing here. So this thing can get bullied around and pushed around pretty easily at the moment. So let's see here. Oh, Powell's up. Let's go on. Let's go back here.
Our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years.
Bear with me 1 second.
What that means is 59.
Day losing streak for the debt
Dual mandate goals
since 1974.
And there's the chair.
We'll try it again. We're restarting.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course.
Yes, they are.
In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly.
I just want to pause for a second. I want to hear what he says about the QT, and then we'll come back up and talk about this.
Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right. He didn't. I didn't hear him address the QT situation. One of the things that I've talked about, and the reason why the back end of the yield curve is doing what it's doing. So let's talk about that for a couple of minutes. Is there's two things going on at the same time. They're dropping the front end of the curve. Meanwhile, they're still selling securities and they're letting the runoff happen with the mortgages that they're own. But the treasuries, I didn't hear him mention it. I really wanted to hear it. Maybe I've just been a little distracted. But the selling of the treasuries are causing two things. It's keeping the back end of the curve up because they're selling those 5-10s that they have on the books. So that's keeping rates higher on the back end. Meanwhile, they're dropping the front end, and they're shifting it toward what I have on the screen here. You know, it's I showed you a chart a minute ago. I don't know if I still have it up. I think I might have switched off of it, but I was showing you the result of going back in Greenspan, where they early 2000s, they just every quarter for 2 years they raised, you know, all the way up to, of course, we got to 06 is where the housing bubble happened and all that. So they were on a course. He says we're not on a course right now, but every time he says that, the next event is another drop in yields. Maybe they, like I said, maybe they pause in January, and then further meetings on, maybe we don't get that. But I still think this is where we're heading. Okay, and I'm gonna stick to my guns on this, because this is the only thing that makes sense for a long time. Yeah, and this is exactly it. Yield curve control is what they've been playing for a while, and that's why I showed you these. There's three curves here on the screen. The red line was a year ago when we had the big inversion. Everybody's screaming that the recession is coming. You know, it's like this great indicator. It's not. Okay, it's a great indicator when market forces cause that inversion, meaning that there's short-term tightness on money that causes the front end of the curve to rise because of that. That's not what happened. What happened was it was artificially moved up by the Fed raising and forcing the yields to be there. It wasn't a market-driven event. So if it was market-driven, I would have been all over the recessionary event that was being talked about. But that's not what was going on. This was a manipulative situation. I showed you a chart just a little bit ago that was showing that scenario when they were on that basically managed program where every quarter for over 2 years they were raising rates. I think they're on this path to get us to this level, and I don't think that there's anything going to stop this, because in the end, if you get to this where I've got on the screen right now, where you have a 3.5, maybe 3.25 yield, I think I heard right that they were talking by year end that they're looking at of next year, they're looking at that rate being down around that 340 level. That's basically what I'm telling you. I just think it happens somewhere between Q2 and 3. I think it gets there faster. What we don't know right now, there's a lot of unknowns right now, because we have a new strategy coming in. There's a couple of things that can affect from the standpoint of the. I'll just come up full screen for a minute. A couple of things that can affect things. Let's say that the Doge guys actually do cut some fat out of the government, and they start to show material signs that they are starting to get rid of the cost side of government and getting rid of a lot of inefficiencies. And let's say if that happens, then you've got a couple things going on. If you can actually get government spending to flatten, you don't even have to get it to go down. If you can just get that under control, and then the tariffs are going to come into play. We'll see whether I was having a conversation with my brother last night. We were talking about this, and is it a negotiating tool? Is there going to be, is one of the folks, will China or who knows, Japan, whatever, are they going to be able to, play little war games with tariffs? Maybe. The car industry is kind of getting hammered right now because everybody tried to do EVs, right? By the current administration, you got to have EVs. So all of these companies are losing money because nobody wants the EVs. Maybe Tesla's done well, but Tesla's robotics and AI company. It's not really cars are really bad business to be in. They're terrible, and in fact, the whole model of the auto industry is, the service. That's where they make all their money on service. Now, cars they're glad to break even on, but they want the servicing because they're junk products and they break all the time and they need fixed. And and some of these dealerships are pretty bad about their service departments. I know we've all had our experiences with those guys. But my point is that Japan is getting in a little of a sticky wicket because of what's going on with the auto industry. I heard Nissan and Honda are trying to merge possibly, and that'll bring in Mitsubishi because I think Nissan is like a major shareholder, like 25 or 30%. So all of a sudden, you're getting like a General Motors. You have multiple brands under one umbrella. So there's a lot of consolidation, a lot of things going to go on. But the point is trying to sell. Are the Japanese going to want to sell F-150s in Japan? Probably not. So it's going to be interesting to see what happens with the tariffs and all that. There is a bit of a lag for sure on YouTube. That's why I like doing some of these other things here. Let me go back to the screen here. Let's go over to let's take a look at where the market's at now. So it's still kind of just pressed new lows again as we speak. So we got a little bit of a bounce and it's new lows here. We're testing the 6,000 level here. Here we go. Just broke it. Yeah, down 57 handles down right now. Let's see if I can get yeah, so here's that 5-minute chart now. Oh, very interesting. We got a potential V bottom here. What's the timing on this thing? Not a clean one, though. PPM1 is trying to bottom. We're at the RXT level, the orange lines. So we got a little bit of that consolidation I was talking about, if we bring this up. But look at this. The algos are still projecting lower down into, I'm looking here at 59.80 is where these averages are pushing down to. So we're seeing some projections here flatlining. We'll see if we can get that. This, like I said, a 5-minute chart. So we'll see what kind of action we get here. We'll continue to watch this fairly closely. Now I want to come back here real quick. I gotta get this scale on the right. I just want to bring this back real quick while we're still hanging out watching this thing, and then we're gonna move on. Let's see what time is it getting to be. Yeah, we'll move on. We'll go through some stocks. We'll look at crude oil. We'll look at Bitcoin, other stuff. Yeah, I mean, this is probably triggered. I see somebody talking about ways of institutional selling, and it may be, but I think that I think it's probably more retail based right now. I think the institutional selling has been happening behind the scenes over the last week or so, where markets are making new highs, and we're just seeing a lot of rotation going on in the markets right now. But this, once again, I wanted to bring this back just for a second, and we come all the way back to this right here is I think that the Fed is definitely on this course where they're going to continue to drop yields. You can see the forecast right now is down to 3.34. This is where I think we're coming. There's also this big pivot number, which is at 3.5, this green dotted line. Those of you who have the indicators know this is a big pivot, and that's a pretty good, yeah, so I mean, VIX just hit 16, making me excited here. Let's bring up something here real quick. And I just want to bring up our database fairly, just to get a look here. And when we come over to the daily, I know this is kind of a little tiny to see, but we're looking at 25% long. I suspect we're going to get a big dump. We're going to go under that 22% level. Which tells me we're going, excuse me, we're going into a full liquidation mode, which means that the database is going to dump everything. We still have 3 sectors long. I would suspect we start to see this stuff kind of tail out of here, especially let's come back over here and just take a quick snapshot of the market. Yeah. So 59.80 is where was being forecasted. We're 89. So we got down to, look at that. We printed down there. We got 86 while we stepped away for a second. So that's what was being projected on the over here. If I come back over here and get the ES, and I'm sticking with the December contract right now. So this, okay, let's break this down, because this is some things that I talked about on the Substack. We've got 3 downward Fibonacci targets right now. They are for 59.12. That's what I was mentioning earlier. We're 59.12. We have the 40-day moving average coming in here at right now at 59.71. So we getting pretty close to that number. Then we got these fib targets on the downside. If we come over here and go to the weekly chart, we're getting down to somewhat of an extreme on the weekly. Let's see where the RXT is 59.76. So we're pretty close to there, but we're also seeing this thing start to turn south again. And let me just bring up the August. Not enough data here on this December contract, but everything's starting to break down. And this is what I've been talking about for the past several weeks. Even though we've been able to press out and get some of these slightly higher highs in this pattern, the distribution that's going on has been a while. Let's go to RTY. Hang on. Let's go to the Russell. This is a real dog. So Russell is starting to get hit again. This is the most telegraphed trade that I've ever seen in my life, and you get these burst up, and we did hit into some Fibonacci targets, but this is just a really bad pattern. This is a weekly graph. Let's go to a monthly here. Even though we were able to get to a new high from this, the advertisement that's been going on this is that I do have some, these are no longer valid, but do have some fib targets up at 3,100 and extreme at 3,700 on the Russell. But for this, the problem with the Russell is it is really a true zombie index because you've got a lot of these regional and small banks in there. There's a ton of them, and there's some good companies in the Russell for sure. But you got to cherry pick. And if you try to just go on the IWM and all that and think you're going to get rich, maybe if you hold it for a couple years, maybe you get there. But not until the big move doesn't come until we get that. If we go back to that yield curve thing I was showing you a bit ago, when the yield curve looks like my projection here, where the green lines are, then the Russell can actually really roll. Because what is that? Because of all the banks and things in there, you're going to have that, positive configuration for those banks to be able to perform well. And until that, then this is just kind of a dead Indian. It's just not going to be able to do much. And we're just flatlining here, and we're actually starting to see some pretty major acceleration come in. We could hit the 200-week moving average on this thing again. There's some support here right where we are right now at the 2250 level. We're at 2275, so there's some support there. And then the next level down below that, you're looking at 2160, and then ultimately you're looking at 2,000 again on this index. This looks like to me, and this is my argument, coming into that Q1 of 2025 is going to be a pretty bumpy road for sure. See ST weekly, S1 on the monthly. Yeah. There's a lot of room to move here, and one of the things like I've been talking about is, we were just looking at the WaveTech database right now if I go over to the intermediate, it's at 57%. This thing's heading down a lot. Well, I suspect we're going to see a lot of liquidation coming into this Friday's run. When we get that, I think we're going to see that happen. That's going to be a fairly big situation. So that's going to be something to watch. So okay, let me look at some of your comments here and just see if we can. The dollar is screaming hot, yeah, for sure. Steve, SD, Steve. Cars are always a bet. They're like the airlines. They're just not good. They're just not good businesses, But all the money, like I said, in the cars are made on the service side. That's for sure. It's sort of like the razor blades. Show them the. I swear that the razor blades that you buy now, I paid like $44 for 4 razor blades. I think it was 4. Yeah, I think it was 4. $10 a piece, and I don't even have a rough beard, and they didn't last very long. It's crazy. I think their planned obsolescence is going on. There's a lot of gouging going on in this economy right now. I don't want to sound like Biden, but that really is a thing. So let's do a couple things here. Let's come over here and let's look at some stocks. Let's go over to some stocks here and take a look. And this is. Let's bring up. Tesla's been on a moonshot. It looks like this is a potential inverted V top on Tesla. So pretty classic. You got up to an all-time new high, get a little rejection. There's a pretty drastic forecasted move. And it doesn't mean, this is just a quick comment for those of you with the PPMs and with the indicators. If you don't have them, you go to kendallreport.com/indicators and get them. But the bottom line is, when you see this kind of collapse in momentum, does not mean that the market's just going vertically down. What it means is that the angle of attack is going to change fairly quick, and you can see the forecasts that you see on these dots up here reflect. Let me go full screen. This is reflecting what the PPMs are telling you. So it's telling you that this collapse, all we're really doing is showing that it's rolled down, but there's a lot of support. But it looks to me that at least there's been an extreme printed here. I'm sure anybody that owns Tesla is feeling pretty good on that. I think I know that our models bought it back at like 170. It's still long. So it's been a huge, like 179, I think was the price. So it's been a big move. I'm going to flash back and forth to the markets here just to get a feel. Yeah, there's just still going down. They printed all the way to 70. Yeah, down 1.24. So this is one of the things I was talking about a bit ago, is that you're looking at the scenario that's been painted out there, that this is the final drop of yield. So now it's no longer dovish. It's now a bearish move. It's more of a hawkish drop. It's like that makes sense. But hey, listen, it gets promoted enough out there, and yeah, I'm sure I'm anxious to rewatch the Jay Powell stuff, Todd, and see what's going on. Let's see if I can get over. Let's get like I said, I'm still sticking with this December contract, that premium. Let me get over to the 5-minute chart again. Yeah, complete collapse. Like I said, it will be interesting to see. Now, we're not getting across the board. We just got PPM1 to turn up here, and it's just so much pressure down. We're looking at 0.79 on PPM1, and possibly maybe as we come into the final half hour or so, we might be able to get this thing to bottom out here. Yeah, I'm going to have to rebuild that access to the market chaos. That's what's happening right now. And like I said, I'm out of town right now, so I'm trying to get that rebuilt. Yeah, I'm trying to figure that out, Green Garden. But I did. It was supposed to be moved to another site, and it was not. And it was destroyed. That would be why certain person isn't here anymore. Anyway, so this thing is just still under a lot of pressure. No bottom in sight. What happened, if you recall, we were talking about that consolidation. Well, the downward pressure is just crazy. And this may have triggered the final, I guess, maybe the straw that broke the camel's back, from the standpoint of, okay, if you're going to rebalance for year end, you got to go now. And maybe that's what we're seeing. But this is not a good moment in time from an index standpoint. And I don't suspect that it's that a good spot either. I'm just putting this back up here. There's no liquidity out there right now to do any kind of selling as far as the futures go right now. So hopefully you got your sells off early, and now you're working the Wow, there's another new low down to 63. So that's printing to the extreme that I was just showing you there on the weekly. We just went below that. So this is pretty heavy selling for sure. So 59.12 is a target, and if you look here, we're just punching them out. 59.60 just printed 60.50. Is 59 even. So I have a theory. If those of you that maybe have the if you have access to the order book, one of the things that happens, we printed 59. So if we print a 64, usually if we get a 5-point bounce off of there, it will set up a little short-term bottom. So we're pretty close to printing 64 here. We'll see what typically will happen. I'll print a new low and it'll run three handles. And okay, here we go. So that was probably a little bit of a climactic. That's what I call a flush in the market. So we got down to 59 even, back to 64. But there's zero, folks, zero liquidity. There is no liquidity in this market at all. There's 4 contracts on a side, and typically there's 50 to 150 on each side. And so here we are, like that little 5-point, that rule is once you get that 5-point, then typically you'll start to get this thing to bounce back a little bit. STX weekly, huh? Let's go over there, take a look. Let's put the weekly up. Yeah, 76 was weekly. We've taken that out, so maybe we're and this is on the December contract. See if I can blow that up. Yeah, we're taking out that. We also have the 10-period moving average right there. This is weekly December contract. 10-period moving average 59.72. So we just bounced off of that. 59 even was the low, it looks like. Yeah, 59 even low. So it looks like we got to bounce off of there. Yeah, I think we're in for, like I said, I've been saying through the Substack newsletter that I think we're going to get some fairly. This is not going to be early start. I don't know if you folks caught when Trump was on the New York Stock Exchange and Jim Cramer was talking to him. I thought it was hilarious because Trump wanted to call him out and be a troll. It's like, well, you're the king of markets going up or down. You know more about it than anyone. Cramer's always wrong. And Trump, he's like, should they buy? He was trying to bait Trump, and Trump's like, I'm not sure I would. He goes, we could have a dip, you know. And here we go, right? Anyway, but yeah, this is fairly extreme. Let's go to the monthly. I think somebody brought this up as well. Yeah, monthly S1 59.79. So whoever brought that up, that was good. And then we're looking at next level 58.98, 58.17. This could get pretty ugly. I know, inverse Cramer. That's pretty funny. But yeah, so this is just a December contract. I'm going to deal with the rollover on Sunday night when I do the report for Sunday. I'll bring in the this premium. It's really kind of It's actually, if I recall, it's a pretty large premium in this rollover. Yeah, let's do oil. We'll stick with the monthly. This is something that I talked about a while ago, and it's been a while since I covered crude, but we're just locked in this really big range here. And the bottom of the range is around the 65 handle, and the top end is around 85. So we've just been kind of waffling back and forth. We can go all the way back to 23, and matter of fact, you could argue going all the way back to November of 22, and it's just been really consolidating. We're trying to get close to a bottom maybe in January, but if Drill Baby Drill's coming, does that mean the oil prices are going to go down? Are they going to be successful at getting this thing down? Let me just rescale some stuff here, see if we can get. This is a weekly chart, and this is the nearest futures. But once again, we've been consolidating here. It does look like we got a shot at maybe coming back in around 75 or so. We're probably going to get sandwiched between the 10-week moving average and the 40. Yeah, we'll do Bitcoin here in a minute. We got about another 35 minutes, so I'll start going through some of your requests and things of that sort. But there's some potential for crude to bounce back. Maybe towards 75, 78 would be an extreme. Yeah, I got to do an MSTR, right? So that should be good. Let's go to. So here's the weekly Bitcoin. This thing is kind of peaking here. We did hit some of the Fibonacci targets that I've been talking about. Yeah, you're going to have to send me an email. I'm not going to remember it from this Green Garden. Yeah, I will. I'll get to it right away. But did you? I'll reach out to you. I think I've got your phone number, so I will reach out to you. I've been wanting to talk to you. Anyway, but yeah, so the Bitcoin is probably going to come into this rising 10-period moving average. There's still a lot of support here. I think we get some consolidation up at these higher levels. If we come over here and go to the daily, these fib targets that I've been talking about here, there's a couple of things we can talk about on Bitcoin. We had the fib target to 109.97. We'll call it 110. We printed up to 108.360 yesterday, and that is that was probably the climactic move here. We're coming back into these averages. Things are starting to. We'll probably end up coming back, probably retesting 100,000 again here, maybe even getting back below it. The inflow of the ETFs are absolutely insane, and what's going on, that's for sure. And let's look at MicroStrategy. Yeah, it's kind of interesting because this is daily. They peaked out. We do have some fib targets, but same kind of scenario as Bitcoin as you would expect. Looks like we come into this. Let's take a look at the algos. Yeah, it looks like we're going to probably seeing peak values, but there is new fib targets out here right now with 462, 502 range, with the extreme at 528, which would be a retest of this high here that was 543. So we could get one of those echo bounces that I talk about. Let's take a look at. Yeah, typically what you're going to get in these type of patterns here is once you get this big up here, then get this, then you're going to get this range here. And the algos are projecting to come down and test this. Then maybe you could get up to coming and getting a bounce from here if we can hold this line right in here. This is what, a daily. So it's fairly noisy here. Let me just let's close this out. Let's go over to a weekly here. Yeah, weekly is very interesting. It's projecting straight down all the way back to 273. That's an interesting projection, but this is probably a more realistic. Let me draw in something here. And this is one of those classic volatility bubbles that I talk about all the time. So let's take a look at this, and we'll look at. Yeah, so we'll get these patterns here from the market grid. And we'll probably get these where we stay within this range here. I don't think this forecast, this will adjust once we get a few more bars. I don't think that's what we're about to do there. But I think we probably end up coming in and setting up one of these. This is typical what I call like a dragon head formation, and typically they'll resolve to the upside. And that's what I would expect. This is weekly, but we're talking well into January by the time this thing is able to get through this. Just looking at some of the, yeah, let's go back and let's see how the market's acting right now. Wow, still 49 low now. Just no buyers anywhere, no liquidity, no buyers. We're down 100 handles. Oh man, that'd been nice to have that one on short. Yeah, this is a big deal. This is going to destroy the what's left of the short-term database on the WaveTech database, and setting up a pretty ugly scene coming into Friday. Whenever you get a sharp decline like this, a lot of times what will happen is you just get a lot of you're getting a mass selling across the board, which basically starts to break down a lot of patterns. So we could see, let me see if I have it up here. Yeah. So give you an idea, right now we've got 8,000, almost 9,000 symbols long on the intermediate database. we could see 2,000-3,000 cells coming in on Friday. It's going to be fairly substantial, I would suspect, from that standpoint. So what is Defiance Quantum ETF? What's in this thing? So somebody. Yeah, I would say one of the things that is tough. Somebody's asking, "What's my anticipation of Thursday and Friday?" I would say, read the Substack. I don't like making analysis about the future when the markets are trading. I feel like you get influenced by a lot of this stuff here. This is a weekly chart here. Looks pretty climatic here. Hot quantum chip companies, got it. That's why that thing's spiking there. Got it. We got to look at United Healthcare, right? There's a, I was talking to somebody the other day. I've been living in a, healthcare nightmare for the last couple of years, and these insurance companies, it's actually one of the biggest scams ever. They don't cover anything that you need covered. So if you don't have money, you just die. If you do have money, they take it all. And it's just, but yeah, we've come down to this 200-day moving average. So this thing got destroyed pretty good, literally, after killing the CEO. See what there's still a lot of downward action. I'm going to keep flopping back and forth, folks, back to the market. Yeah, so we finally got what we print all the way down to 49, and now we're back at 64. So that's a pretty decent bounce. But there's just I just can't even emphasize how little of a lack of liquidity there is in this market. This is very dangerous to be involved in, for sure. Just That's interesting. Somebody says they keep getting booted from the stream. That's interesting. Yeah, YouTube doesn't like me. I can tell you that. Yeah, I think somebody's talking about AI for 2025. There's a bunch of stuff going on right now, especially with the. Let me talk about that for a second here. Let's get the screens off. So I'll come up and talk about it. But I think AI is going to 25 is going to be the first year that we really are getting. I think where AI is going to start to really flow through a lot more companies and have more influence on the economy. I think 26, 27 is insane. We're going to need a lot of energy to do this. And I'm still really big on these micro nuclear. I know that's been a hot place. There was some company that I think Sam Altman's involved with. They signed some non-binding deal or something that has no relevance whatsoever. Yeah. So you're welcome, Texas Dave. Yeah, don't get too hurried about getting back in. Just be very selective. I think as we come into year end, we're going to go from there. That's interesting, isn't it, Christoph? Good to see you around, man. Yeah, I've thought about switching platforms and stuff, and that's kind of what we, just going to the private Discord. And that's why I want to start an insider channel, and I think that's going to be the way to go. I'm not sure. I've been disappointed a lot with YouTube, and I worked really hard to maintain and build the channel up, only to see it go off. And just they had me at 38,000 for a year, and then they let me go to 45, and and I'm not that active right now, so it makes sense. I can accept what's going on right now. It's just before, when I was doing daily streams and was on YouTube every day. So here we are. We got that big bounce. Let me bring it back up on screen for you so you can see it. We're coming right back down, retesting these lows here. So there's just relentless selling, no liquidity. All this stuff just continues on. New lows. There they go. Let me get out of the way here so you can see. Yeah, 48.50 now. Yeah, they're just waves after waves of selling. And, this is one of those stampede out days. It's, wow. They just got a flush. Look at this. Down to, new lows, 47.75. Just continues to print this thing down. Yeah, I have to figure out how to stream on X platform. I need to figure that out. Yeah. There's new lows, 43 prints. Yeah, I think we'll stay here right now. This is a final half hour. Let's just 42s. I mean, there's no bottom here. Almost down 2%. $42 prints, a little bit of a bounce, but man, this is. Yeah, let's come back over here. So Dow yen printing what? 154. There's some targets here. Fib targets 161. 169 all the way to 174. I'm going to go monthly. This is a weekly graph. I'm going to go monthly on the Dow yen. Let's just go over there for a second here. This is not a good hand. I'm just trying to see if we can get to a longer. Yeah, here we go. Yeah, this is a really good chart to look at from the standpoint of looking at Dow yen at where the Dow was once upon a time. Up here at 287. This was back when I was starting in the markets. Here's I remember this rally in 70, 79, 81, all the way into 82. But look at this collapse of the Dow relative to the yen. So really, we probably could figure out we're probably just coming in. These values here are just a 50% retracement of this great debacle. Look at this. So let's go. This goes back to 1971. This is a Nixon president, and you're looking at 341 down to 75. So it's a big deal. Yeah, the good news, it used to be people going away for holidays. The way I travel, I've got two 32-inch 4K monitors with me on this trip, so I don't go anywhere I can't trade. I don't know if that applies as much as it did once upon a time, but it's possible. The one thing, since I went to Mac, I have a Mac Mini. It actually travels pretty well. I've got a little case for it. Just got a lot of wires to hook everything up. But other than that, it travels pretty good. I actually have like a carry-on case that my whole computer goes on to the monitors if I'm traveling, or if I go somewhere, I'll just buy a couple monitors and I'm ready to roll. So, but looking at this, the longer term stuff on the yen is very interesting. Yeah, you would. Yeah, I mean, a weaker dollar would be probably more advantageous. But yeah, let's go back. Thanks for giving me heads up here. Yeah, 38 now low. There's just no bottom in sight. They're going for 2% down, it looks like. Yeah, for sure. I mean, if you look at one of the things that in the old live trading room, one of the things that you look for is this erratic type behavior, but this is, yeah, the order book's just emptied out too. There's literally no one home. Yeah, where's the bounce? I don't know. 59.10, that 12. That's one of those Fibonacci targets. We just printed the lows again. We'll sit here and watch the order book trade a little bit and talk about what's going on. But we're just not seeing any activity. Looks like they're going to try to punch the lows again. Here we go. They printed the low. There it goes, 37, 36. I mean, there's just nothing. I mean, right now the platform's not keeping up. It just refreshed. Yeah, it was like it was printing the lows, 35.75, new lows again. So yeah, there's just nothing going on. There is no buyers available. So here we are, almost 2%. I was just saying they're going to take it down too. We're 1.97. There's another new low, 33.75. 99, 199. Then a little bit of a bounce. That's good, Todd. Let's see if we can get over there. Yeah, I'm just trying to get this scale. It's just so, look at this. Talking waterfall. The algos are still, yeah, here we are trying to put us down towards the, see if I can bring up and get dual screens going here. See if we can get the order book and watch the algos. Yeah, 28 low now. 27. Yeah, this is full on panic. For sure. Yeah, you should be able to run intraday on the pairs. Here's 25 low. Yeah, new lows again. Hang on. Yeah, we're down 2.14 now. We printed 22.75. Wow. This is pretty amazing, folks. That signal we got on Monday to liquidate those longer term trades are really interesting with this type of action right now. Yeah, 21s. I mean, I can't even get to the bottom. The scale is not keeping up with the prices. It's trading down below. I can't even get it to refresh right now. There it goes. 16. So here's the 12. That's fib target 1 that I was just talking about. We'll bring that up. Yeah, there's 12. Somebody asked me we were trading a 50 handle. So maybe 12. Here we are. Let's see if we can find that that number. Yeah, so here's the fib targets. 59.12, fib target 1, 58.37. So we hit 12 right on the money here. You can see these red dots here over on the right-hand side, low target 1, 59.12. Yeah, we went right through the 40-day like it didn't exist. And, you know, I was talking about in Substack that there's a bit of a distribution pattern. We're just still no lows. 09. They're going for evens. What the hell did Powell say? Yeah, 05s, still new lows. Yeah, I don't know if there's any algos here. This is just a free fall. Here's 03. 0375. What is this down now? We're down 2.36%. Yeah, I wouldn't be. Yeah, what we print low? 0375. They're coming at them again. Here they come. New lows again. 0150. Yeah, evens. Just took out evens. 98. 898's printing. 96. This is a full-on panic, folks, what we're watching here. Let's go over to this screen here. Yeah, this is full-blown panic. Down to 95 print. What did I say the next fib target was? I got to go back here. Uh, 5837. Wow, 86 prints. Now there's a decent little bounce. Yeah, I think Neil. I think when it starts to feel good, when it feels so good you can't stand it, you probably should be taking them in. Sell them puts, but yeah, it's just like. Hey, Bo, good to see you around, man. Yeah, so what we print low, 86 back to 92, but they're just waves of selling, down 2.5%. Maybe they are going for 3. Yeah, I think IWM is just nowhere to go. I covered that earlier. We'll take a look at it. Is this the reset? Going all in for Santa Claus Rally. Yeah, look at this. We got a nice bounce going here. 97 printed 86. So 10 handle run, but I'm telling you, there's no liquidity here. This thing can go anywhere right now. I mean, there's a bottom somewhere. We used to have a guy come in on I think the orders are announced, like for the MOC orders come in at 10 minutes still. And that always is a point where things can change pretty drastic. Yeah, so 93, low 86. I'm trying to get there. 650 low. Here they come again, Adam. Yeah, I wouldn't give Buffett that much credit. Yeah, look here. They're trying to press them one more time, maybe here. We're down 270. Wow. Here we go. New lows. 86 even. 84s. 83.75s print. 81s. I know you guys are delayed like 20 seconds. 79. 77 printed. Folks, this is pretty extreme. $74.25, 74 even. Down almost 3%. Good call, Bo. Yeah, I don't know about -5. That's pretty drastic, but 72 printed. Another little mini bounce going on. We'll see what happens in 5 minutes. Let's go back over to this, see what the algos are telling us. We got a potential V bottom right here. What do we got in timing? Got a minute. Hang on. I'm sorry. This is daily. There we go. Yeah, we got a little mini V going off of this last one. Now we're all the way up to 92 from just trying to get to the bottom here. Hang on. $72 to 92 back to 84. I'm going to bring up the algos here on a 5. Yeah, trying to get a little V bottom going. Got a green bar going. Kind of flashing back and forth, folks. Yeah, here's almost 450 on the yields here. I'm popping around just looking at some things here. Yeah, look, we've got some fib targets up here for 4.62, 4.83, and 4.95. So this is the 5% everybody's talking about. But look at this. Look at this run we got going here, folks. The vertical. So right now we're looking at 72. We're looking at almost 40 handle run here. We're coming in to that 10-minute till mark. Yeah, so 59.01, low 72, so 30 handle run. See if I can get this back up here on ES. The daily, get over to 5 minute. Yeah, so far that V bottom was pretty good, which we were kind of tuned in, but right now we're looking at 40 handles and just vertical. So we get down right at 3% and got a major reversal. The Algos gave a V bottom on that last bar, so the next bar should have been a turnaround, which it was. How far she goes, it looks like we're getting, look at this, 12 hand. Now we're back to 59.12. 72 was the low, I believe. Yeah, 72.75 was the low. Now we're at 12. So 40 handle run off that low. So you knew it was coming. You got these lines here. We finally got a break in the rope here on here. Got a decent bottom trying to form here, but this was a disastrous day. Down about 3%, back only down 2.35%, 2.4. So they're trying to come at them again. Order book's getting a little more liquid than where it was, but not much. It's still very erratic. Looks like they're trying to come at them a little bit here again. We're at that 10-minute mark. Nothing big yet. That's 10 minutes to the close. Yep. So it looks like maybe a little backfilling here in the last few minutes, but with this kind of day, you know, if you get a big short covering rally, anything's possible. We may have already had that. That's pretty impressive. 72 to yeah, we haven't looked at the hourly, but we should look at that. Wow. So a little bit of selling coming back in again. We'll see how this thing finishes out. We got another 6 minutes. I'll come back up on screen here once we got this close. Let's go back and watch the live screen here. NVIDIA's green, somebody says. Yeah, that's one stock we didn't look at. Yeah, there's a funny Leslie Mack. I'm not sure if I'm pronouncing you right, but one of the things I've taught in the old trading room all the time is learning how to fade yourself. And you can do that through journaling. That's something we'll talk about in the symposium. So, yeah, but if you can learn how to fade yourself when you have those feelings, it's one of the best techniques ever. Especially if the stomach gets really tight and you're scared, that's usually the time to buy or sell or do the opposite of what you're feeling. Yeah, here we are. They're coming at them again here. 90, 96, 95. Let's see how far they can take them back. Yeah, don't short the low in the hole. Absolutely don't do that. Do not do that. Yeah, so 95, 72 low, trading 95s back under the even handle, back under the figure at 59. Let's see what happens here. You know, how many times the woulda, coulda, shouldas? Here's 91, it's trying to get down here again. 20 handles off the lows of the session. We're back down 266 on the day. Order book is kind of filling up a little bit. One of the, the dollar, just everybody's piling in. So still hanging right around this 92. We'll see if it sets up a little right shoulder here. Let's see if we can get to the algos real quick. Just take a look here. Let's get over to the 5 minute. Yeah, still looking like some downside. You can see the red dot indicator is still showing a little pressure. Here's 89, 80, trying to trade 88s here. So they're pressing them. What we got? We got minute 40 until this bar closes. But here we go, 86. They're coming at them pretty hard. Let's go over to this screen here. Yeah, we're kind of right at the point. If it doesn't hold here, then we could print new lows into the close here. It's got to hold right here. And this is a ugly, ugly, ugly day. Here's 89s. Yeah, the value's probably right here at 80, 87. That would just stick it out. I couldn't even get it out in time. So they're coming at them heavy again. Another round of selling with just what? This is the close, folks, right here. So we're like at the lows of the session here, trading in the 70 handle again. Down 292. I mean, they look like they're going to go for the low. We're almost, this is the closing bell that we're in right now, the final minute. I can still hear, oh man, new lows. 69, panic selling on the close. Wow. We all the way to 65. There's the close. Yeah, that was insane what we just watched, and we're not done. Now you got the aftermarkets. Everybody's got to square up. I have to tell you, folks, and we had. I was talking on a Substack when we took out that. I know normally when I talk about our database, 42%, that 61 number that came out, that was the low for the year. When that came out last week, it was a sign it finally broke. And now I'm sure we're setting for thousands of exits coming in. That's interesting. Coin down over 10%. Yeah. I mean, we're still trying to print the low 63.50. They're not done. Here they're coming at them again here, folks. Wow, there's the lows, new lows, 62.75. A typical pattern in a monster sell-off is they'll print a new low, they bounce, and they come back and print them. And yeah, this is... So down 3.1% now. Thanks, Snook. That's a great comment. I appreciate it. Yeah. Yeah, so 62 prints low. Maybe get a little mini bounce here. Folks, that was something else. So I gotta do this. So here's the deal, folks. I haven't looked to see how many orders that we got, but going to be doing the strategic trader. It's going to be on January 23rd, 24th. One of the things that I mentioned, we're going to start basically an inner circle group as well. That's going to it's going to be very educational. But this is one of the things that I'm doing on this conference is you're getting 3 months of our portfolio management software included in on this event, and I'm going to show you how to use that to confirm trades, how to use the indicators. If you don't have the indicators, you're going to need them. If you sign up, I'll send a special link for a really cheap and dirty for the indicators, so we'll get them to you cheap if they go there. But anyway, this is going to be I think a really good event. I did an event last year. I'll just so you go to kendallreport.com/event, and I did one of these last year about in early November last year, and I tried to do everything, and it was way too much. So in this symposium, we're focusing in on really a couple things: trade strategy, how to actually get exact trade signals, which that's why I'm putting out WaveTech, and so you'll have access to 15,000 symbols and buys and sells. All stocks, unfortunately, cannot do the futures on that, but at least we can get the stocks. And I have in my possession, I haven't had a chance to do it, get it verified yet, but I do have the models a version of the models for Trading View, and I'm not sure when they're going to get released, but that's going to happen as well. But this is going to be, I think, a really good event for folks to come to, and we're going to do live trading. I believe those. I think the 20. I think this is. Let me just look at something here. The 23rd and 24th of January is actually a Tuesday and Wednesday. There's going to be, I believe it's going to be from 2 to 5. So there's going to be 2 hours of presentation, 1 hour of interaction with you folks. And then once we get the 2 days done, there's going to be a mastermind that you're going to come back, and we're going to do basically probably a 2 to 3 hour just Q&A, going through things that you learned from the symposium, trying to get through all that stuff and get you to that next level of understanding will be the plan. And this is going to be on a Zoom meeting, so there'll be no delays. It'll be as real time as we can. And so make sure you get signed up, kendallreport.com/event. That'll get you to this page here, and you can go through and just look at the stuff, but you can just click on this, yes, I want to attend, and off you go. Don't click on it twice like Green Garden Capital does. I'm not sure what happened, but anyway. Yeah, the plan is this, is to record all these events, and then we're going to have access to those as well. Yeah. Yeah, it did take a long time to get uploaded. You're right. And hopefully this one won't take as long. The problem that we had last year was it was kind of jumbled around, and it needed to, that's the best way, had to edit it up. It was really bad. So I'm hoping that on the other thing that's going to happen with this is I'm putting a manual together on that's going to come along with this. So hopefully this will be a much more effective. Learned a lot from last year's event, and hopefully when we get that thing turned around, it should be fairly simple, even if we just get the raw videos up there. And I don't recall why that happened, why it took so long. I seem to have, last year was a pretty challenging time. I think I was the hold up on that. So anyway, yeah, so here we go, all the way down. Yeah, I'm just looking here. I think, hopefully you guys are still hearing me. Okay, yeah. Yeah, Merry Christmas to everyone. Yeah, thank you, Christoph. I miss our old daily streams we used to do like this. That's cool. Yeah, appreciate that. Yeah, it looks like one of my connections collapsed here. Yeah, 40 low, so they're still pressing them here. Wow. 58.29, I'm not sure what that is, but yeah. Okay, folks, like my world map behind me, it's like I said, I'm out of town right now, but I wanted to do this. I wanted to get the announcement done. Hopefully we'll have some emails out for this event, but I did want to get some things going. And get everybody in on this event, because one of the things that I'm learning a lot about life is that, you know, I want to get a lot of this information out there and have it stored so that it can be out there for you folks to use for a long time. Yeah, you may be right about the real selling. It'd be interesting to see how the Asian markets and everything else comes overnight. I would say if you don't get my Substack, go to kendallreport.substack.com, sign up. You get there's a, I think, 7-day trial, and it's $8 a month, and you can buy a full year for like $6.50. I think it's $80 from there. That's something we didn't look at with, let's take a look at let's go to gold here. Let me go get you back on screen. Yeah, gold got hammered, I suspect, down 2%. Yeah, the gold is probably over. That was probably a good trade when Biden was in, but maybe not that good a trade with Trump. We'll see. Yeah, I think I think what will be interesting from the standpoint of folks are asking, you know, do you think it's going to be like a 22 sell-off? Here's what I believe is likely to happen here is that we're going to see a pretty decent retracement, but I think it's going to be controlled. But I do think the first quarter of 2025 is going to be a tough one. Yeah, I think we'll see some more selling coming in Bitcoin. Everything we were looking at Bitcoin related looks like a test of 100. But we're likely to stay in this sideways range. There's still some very strong uptrends on any of the crypto assets. They're still in there. That's crazy. VIX hits 29. Yeah, especially the tech stocks. Everything got unwound today. I'm anxious to do my homework tonight and to get that done, but make sure you get the Substack. Make sure you go and check out the symposium. It's about 5 weeks away. So the way it's going to work is once we get to right before the seminar's happening, there may actually be a meeting where I'll get you into I'll be sending out links. And remember, the first 30 that sign up are going to get a full hour one-on-one consulting with me. So I've really enjoyed, I've gotten to know a lot of you. And so if you haven't got that, you know, make sure you do. And back on screen again, kendallreport.com/event. So looking forward to seeing everybody there. And I'm hoping that I'll be able to get online before year end, but more importantly, my annual report is going to be really, really good. Yeah, I'm hoping Texas Dave to do a much better job this year on the presentation. I've got a lot more. Like I said, I learned a lot from last year. So I think this one will be really, really much more focused because I tried to do too much. So I was working on the presentation just the other day and kind of fine-tuning some of the things. And I just want to be really careful about staying very focused on everybody coming out of the 2 days with some solid things to be able to look at and to be able to trade off of. And I think having WaveTech around is going to be really important to having some things done. And I'm working on also, for those of you with WaveTech, I'm working on a bunch of prompts for ChatGPT right now. I've already run a bunch of stuff. You folks may have seen, let me just see if I can bring something up. There's a couple things that have been presented to you. Some of these charts that you're seeing here, this chart here came out of ChatGPT by just prompting, telling it to make a dashboard and literally cutting and pasting the data in. And this is not the interactive version, but it put it in React, which makes it interactive, so you can get in-depth techniques. There's some other things that you can do really amazing, and that's the other thing that I'm going to be embracing. I've actually got a guy in India that I've done a fair amount of work with, and we're trying to put a chat GPT program together where we're using the API, and we're going to build a new app out of that, which is one of the things that you can do with WaveTech is you can start to ask questions. I always tell folks that the thing that you want to have going through life is about asking the right questions more so than knowing the answers. But if you're asking the right questions, you have an opportunity to basically really pull a lot of information out. In the case with WaveTech, there's so much data in there, and we're working on getting some things together right now. So hopefully the plan is to build the app out start with a high level and then build and get it to grow. And basically the WaveTech platform will end up getting rebuilt. Initially, it'll be pre-built strategies and portfolios, but it's going to have a lot of the data is going to be researched. And when I show you folks some of the stuff that I've been working on with the prompts, it's absolutely amazing because you can actually have it like I actually did some things with this that I have on the screen right here as I asked Chat to write a report about the current holdings and what type of things I should be looking for. Is there any symbols and things that are within this database that we currently own that we should be looking at? So it goes really, you can really go in a lot of depth. And my plan is just to have these pre-built prompts. It'll even be dropped down and you just push a button and it's going to give you reports and all kinds of stuff. Especially for our institutional guys, I've been showing them some of this stuff, and it's just it's a game changer. So you get it's going to be big, folks. So 2025 is going to be special, I think, and so let's continue to hang out. Hopefully, I'll be able to get. I'm not sure what next week looks like. It's Christmas week, but possibly the final week of the year, I'll be able to get back up and do another live stream. And I would definitely get kendallreport.substack.com, at least sign up for a trial. And there's going to be a lot to talk about tonight. So anyway, folks, thanks for hanging out. We had a fair amount. I think we had about 300, 350 at one stage. So that's good. That's good. So anyway, folks, thanks again for watching and hanging out, and appreciate everything. Merry Christmas, Bo. Appreciate it. I'm down, not quite. I'm in North Valley right now. So anyway, I appreciate everybody's comments. I really do. Have a great day, and we'll talk to you real soon.